Hey everyone, welcome to the Intro to Fundraising Alternatives and Ask Me Anything with Nick Speller. My name is Jake O'Shea and I'm the Investor Relations Manager at Capital Factory, the most active early stage venture capital firm in Texas since 2010. I manage Capital Factory's investor relations programs, helping our portfolio companies prepare for and raise institutional capital by connecting them with the right investors. Really excited for you all to join us today. We've got a great lineup of questions. But first of all, I want to pass things over to our CEO of Capital Factory, Josh Baer, to share a little bit more about Capital Factory. Take it away, Josh.
Howdy. My name is Joshua Baer, and I'm the founder and CEO of Capital Factory. Capital Factory is the center of gravity for entrepreneurs in Texas, the #1 state for startups in the U.S. Thousands of entrepreneurs, programmers, and designers gather day and night, in person and online, for meetups, classes, and co-working. With boots on the ground in Austin, Dallas, and Houston, we meet the best entrepreneurs in Texas and introduce them to their first investors, employees, mentors, and customers. Capital Factory has invested in more than 300 Texas startups over the past decade. Whether physically in person or virtually online, Capital Factory is buzzing with energy and activity every day. Start with all the geekiest events on meetup.com and sprinkle in out-of-town guests, book signings, hackathons, innovation conferences, and pitch events. We're talking about thousands of participants every month. Most of the events are free, open to the public, and streamed over the internet. Capital Factory is all about community. Everyone's here to meet other people who can help them on their journey or to help others find their way. We kick off every morning with a text-based Ask Me Anything session with a mentor or investor in our Slack channel. Anyone in our community can ask questions in real time, and everyone else can see the answers. These are some of the most active investors and the most successful entrepreneurs in Texas. Those same mentors and investors do regular office hours where they volunteer a few hours a month. It's easy for any of our community members to find people with specific interests or expertise and to book a 30-minute meeting with them. With hundreds of mentors and investors in the network, there are dozens of meetings happening every day. Our co-working space provides desks, offices, conference rooms, classrooms, a podcast room, a video conferencing booths, and more. But the most important spot is the kitchen, because that's where everybody comes together. That's the real reason everyone's here, to meet each other. And every day at Capital Factory is demo day. Maybe it's the local angel investor network or a venture capitalist from out of town. Maybe it's one of the Fortune 500 scouts looking for new tech or a state or federal government official. It's delegations from other countries, school kids, army generals, and celebrities. We've helped entrepreneurs get in front of Tim Cook, the CEO of Apple, Satya Nadella, the CEO of Microsoft, Sundar Pichai, the CEO of Google, and even President Obama. How do we know who to put in front of the president? Well, first, they go through an intensive interview and assessment process where they're vetted by our staff and our mentor network. We categorize them by industry and technology and score them based on traction and potential. Then they have to work their way up to the top. On the way, they'll often meet with members of our Innovation Council of Fortune 500 scouts looking for startups with technology that can give the big companies a competitive advantage. They're hanging out in the kitchen of the co-working space and in our Slack channels online. They partner with startups to go after big government contracts with the Army Futures Command, Air Force Ventures, and the Texas Military Department. The money is flowing. In the past year, 30 startups in our community received more than $60 million in non-dilutive funding through government programs. Capital Factory is also the official Google Tech Hub for Texas. Google plugs us into a global network of other entrepreneurial communities and creates unique opportunities to help our startups attract investors, increase diversities, and access Google services. All of this activity creates exclusive deal flow and data for our investment fund. Our goal is to invest in the best deals in Texas, no matter who leads them. Over the past 10 years, we've secured $110 million in pro rata, super pro rata, and follow-on rights in more than 600 companies. We watch them all interact with our mentors, investors, Innovation Council, and each other, so we know which ones to invest in. Some of our most successful companies include Aceable, Coder, Data.World, Icon, Sensei, Storable, and WP Engine. Are you ready to quit your job and become an entrepreneur? Do you know someone who is? That's who I want to meet. And those are the kind of people who I can introduce you to. You can message me directly on Twitter at Joshua Bear or email me at josh@quityourjob.com.
Awesome. Well, thanks so much, Josh. And audience, definitely do blow him up on Twitter or reach out to him directly over email. But to keep things moving, next we want to give a huge shout out and thanks to our partners over at CACI for everything that they do to support the startup community here. CACI provides professional services to many branches of the U.S. federal government, including defense, homeland security, intelligence, and healthcare. Here's a quick video from CACI. All right, what an awesome video. Love the music, definitely got me pumped up. Thanks again to CACI for being such great partners to the startup community here in Austin. So diving right into it, today I'm going to be joined by Nick Spiller. Nick is a fundraising coach based in Austin, Texas, who's spent over a decade building the startup community right here in Texas, specifically in Austin, both through his service at Capital Factory and the University of Texas. Actually, for the last 3 years, Nick spent his time establishing the Capital Factory's investor relations team. So the team that I'm a part of. Nick actually hired me and was my first manager. The investor relations team has facilitated over 5,000 curated meetings between startup investors and portfolio founders. Nick's also helped raise 3 different funds, 1 traditional seed stage investment fund, along with 2 annual accelerator funds. And he's helped introduce over 100 institutional VC funds to the Texas ecosystem. Today, Nick is focused on developing financing methods for startups beyond traditional venture capital that make startup investing a better fit for family offices and for individual investors. So, really, really great addition to the conversation. It seems like this event was made for him. So with that, I'd like to invite Nick Spiller to the virtual stage.
Hey, Jake, and howdy, everybody out there.
Hey, Nick. How's it going? Great to see you.
It's going well. Excited to be back and talking about alternative financing.
Awesome. Yeah. Well, thanks so much for being here today. I think just to kick things off, I want to start off by diving into your story a little bit, because I think that gives you a really unique perspective on the topic today. So tell us, how did you get started working with startups and what led you to the position of the fundraising coach that you're in today?
Sure thing. My story in startups starts my childhood, which was in Flint, Michigan, or a small town outside of Flint, Michigan, which has a very rich history and not so rich community today. It's the birthplace of General Motors. In the 50s and 60s, it was one of the fastest growing cities in America. And when I graduated high school, it had declined as General Motors moved their manufacturing jobs overseas. The whole industry was built around the one company, and the economy collapsed. And it was, I think, in the Great Recession when I graduated high school, the unemployment was around 20%, and it was the FBI's most dangerous city in America. And I was very lucky to get into the University of Texas and moved to Austin in 2009, which coincidentally was the year Josh started Capital Factory, and bumped into him and very quickly discovered entrepreneurship the way people do when they move to Austin, and which was unique for me because in Flint, entrepreneurship was a foreign topic, but it was really interesting and something I gravitated to because for me, the core driver and the purpose of entrepreneurship is to unlock prosperity and freedom for individuals and families, right? And I think when I think of entrepreneurship and I think of the American dream, I think that's like the big goal is like, giving people the means and the ability to work on what they want to work, not just the job that can pay the bills. And so that's what drew me to it. And then after working for a handful of startups in college and starting the Longhorn Entrepreneurship Agency there, I fell into the venture capital side of it. Like you said, at Capital Factory, worked with a bunch of VCs and really got to see a lot of deals that Josh mentioned, investing in 300 companies over the last decade. I got to see probably about 75% of those decisions, deals, so a lot of exits. Got to understand the behind the scenes working of venture capital. I think it's an awesome way to build big businesses. And it's a financing method that has proven to be the best way to build the largest companies that have ever lived on Earth, right? And the unicorn thing. But if you look deeper, like the other side of it is that the wealth that's created from venture capital goes back into governments and universities in a lot of ways. And it's because the investors in the funds are endowments and pension funds and that's who's funding the VCs are these very large institutions owned by universities and governments. And at the end of the day, you don't see a lot of opportunities for the everyday entrepreneur to really achieve an exit and liquidity that can create that prosperity and freedom, right? And so really, and again, I don't have any problems against VC, but I think when it comes to optimizing for the total number of people who have financial and strategic success with their startups, you're going to be able to get a lot more winners through small revenue-based financing deals, crowdfunding deals, or just deals that are set up to grow companies to maybe 10 million in revenue, 15 million in revenue before exiting, instead of 100 million or plus when you kind of once you get the VC, that's the impetus is to hit that $100 million in revenue mark. And that's there's a lot of risk that comes along with that. And so yeah, that's why I've kind of broken off and really diving into these alternative finances to help set up companies and finance them when they're not maybe going to go scale hyper fast and become a unicorn. I can actually raise a little money, grow to a modest amount, which is still an awesome business and a major feat. If you build a $5-10 million business, it's not anything to take lightly. But being able to do that and then exit and have a good deal for your investors and for you is really important to me.
Yeah, definitely. I think, the hyper focus of, like, as you mentioned, the unicorns from a VC perspective completely eliminates a lot of the very attractive exit opportunities for companies that maybe aren't worth $1 billion, but, are doing 10, 20 million a year in revenue. So yeah, I think you're tackling a huge space, and, I've been really excited to kind of watch you. So diving into some of the questions that I have specifically, what do you see as some of the limitations of VC funding? Where does it kind of miss the mark?
Well, it's in these everyday businesses, right? And you have 50 new unicorns minted every year. I don't actually think there's ever been 50, but around that number. You've got 10,000 companies that are supported by venture funds at any one time. It's about 1% of those companies of the 10,000 that will actually achieve ultimately the unicorn status, and the rest of them don't have a lot of options. You kind of, because you raise money at these high valuations which leaves the ability to raise more money in the future. You might get to 50-60 million dollars of revenue, but you've raised 30 million and your last valuation was 100 million. So you really can't get the return you need for investors until you hit that super high growth when you raise a bunch of money from VCs. So if you're just saying, hey, I want to go launch a really cool store in Austin that's going to be the hub of some really cool community and make $1 million a year, VC doesn't really work for that at all. So yeah, I think that's the big thing. It's if you really want to light the world on fire and be the next Elon Musk, and that's truly your goal, like go for it. I think that's really the situation where you want to partner with VCs and really develop that massive outcome. But I think for there's 30 million small businesses in the United States compared to the 10,000 that are funded by VCs, and I think it's like 7 million of them report not inadequate access to capital. So you're, short millions of companies that could be financed, and but just don't really have that avenue for it.
Yeah, the traditional entrepreneurs seem to be a little bit left out because they need to be this crazy billion-dollar unicorn, world-changing company, as opposed to just a really solid business that does what it does well and returns lots of money for the shareholders and early investors.
Right.
You kind of touched on this a little bit, I guess, with that previous answer, but what types of businesses do you think are a good fit for VC funding, and what types of businesses are not? And really, I guess what I'm trying to get at here is, what are some frameworks to evaluate yourself as a business to determine if VC funding or if alternative sources of funding are best for you?
Yeah. I think the first step is really a soul searching and being honest with yourself on what you want to do with this business. And there's big, and then there's VC big, and I think sometimes it's hard to tell the difference if you haven't raised money or been in these companies. What is the difference from growing a company to 10 million to 100 million in revenue? Right? I think it's a big difference, and but it might not feel that way to an entrepreneur who's just trying to get their first round of funding, right? And so I think that's a very for initial step. And if you're thinking, man, I just want to see this thing in existence at whatever scale, I want to live my life as an entrepreneur, and I want to solve a problem for some customers, I would recommend looking at other financing options. But if you're like, hey, I've got nothing to lose, I've got an idea that no one else can really execute on, and if I go do this, nobody else is going to be able to do it in the world, and you can kind of walk through the door and shut it behind you, like if Google, if you get everyone's search engine, all their data going through your platform, you've got this awesome advantage from an advertising standpoint that no one else can really catch up to anymore. And so I think those are the companies that really deserve unicorn status, where you've got the opportunity and the ability to seize that opportunity that really isn't going to be able to be captured by the next person that raises a bunch of money and beats you out. The defensibility factor is big.
Yeah, definitely. So, when I'm working with entrepreneurs at Capital Factory, and you probably experience this too, but it almost seems like if you're running an early stage technology company, really your only resource for funding is going to VCs and selling equity or raising a safe note or a convertible note and going that VC funding route to build your business and continue growing with growth capital. So, what I'm excited to hear about from you, what are some of the most common alternatives to VC funding that you've been able to find?
Yeah, I think there's three that really stick out. One is might seem almost the same thing, but there's a subtle difference with angel investors, and you can still do an equity round or convertible debt or SAFE with angels with the intent to fully fund the deal with angels, right? And one of the most surprising things that I learned when I started talking to people about alternative financings, I reached out to 6 or 7 executive directors of angel networks in Texas, and I asked them, I said, what percentage of the deals that you're looking at and that your network is funding that intend to go on to raise VC? And it was 100%. They all said, I think it's like 100%. They want to raise angel and they want to go raise VC, which is peculiar because 10 years ago, you would see deals that would get fully funded by angels, and you might just raise $3 million, $5 million, grow to $20 million, sell it for $50 million. And then those angels would get a huge 10x return. And you don't see those deals anymore. And I actually think that's a huge opportunity to bring that back. And no one's really thinking about it, but still kind of traditional equity deal. The other two that are very strong are revenue-based financing and crowdfunding. I think both have their strengths, and like the timing's good for both of them. Revenue-based financing, which is paying back investors a fixed percentage of your revenues until a return cap is met, so 2x or 3x return cap. I love that idea because it positions the investment in your startup like a cash flow investment. And something you hear from especially a lot of traditional investors in Texas is that startup equity investments are so different than other investments that they've made, especially successful investments they made, because of the long hold period. Essentially, you buy this equity and the company goes and builds value in that equity for 7-10 years, and you sell it way down the road for a big return, right? And it works on paper, but there's something about getting a check in the mail that investors like. And with the revenue-based financing, you turn it into a cash flow investment. So it's like a real estate property or an oil well where, on a regular basis, you're getting a return on your capital. And that positions you for a different type of angel investor. And there's a lot of angel investors out there that's how they think, is they're buying cash flow, right? And they want to actually go and invest and get that cash return. And that the equity piece is just a whole nother piece that they haven't sunk their teeth into yet. And actually they've tried to, and they've gotten a lot of black eyes. You'll hear a lot of stories of, investors who gotten 1 or 2 venture deals, didn't really know what they're doing, lost $1 million, and they're just never going to touch it again. And so revenue-based financing, I think, solves that problem. And then crowdfunding is just really been a long time coming. The unique thing about crowdfunding is you can have lower minimums, and you can actually do a Reg CF raise where it's you don't have to be an accredited investor to invest. And so for companies that have strong brand followings and communities, this can be an awesome way to raise money. And also the platforms have worked around a lot of some of the initial issues and have developed their own investor audiences. So if you can get initial traction, I hear of a lot of startups who are getting a bunch of investment from investors that are on these platforms who they've never talked to, who don't know the company, and they're just purely coming through Start Engine or Republic or one of these platforms too. And the new rules, I think, just went into place this week or last week, which raise some of the minimums that you can raise as a company, and also some of the some other favorable terms that make it a little easier to raise on crowdfunding. So I think both of those, revenue-based financing and crowdfunding, are coming on very strong.
Awesome. Yeah. So really 3 main alternatives there. It's 1, angel funding; 2, revenue-based financing; and 3, equity crowdfunding.
Yeah.
I'd like to dive a little bit more into that point you made about angel investors and kind of how that all works, because that's really interesting to me. When you think about kind of an angel investor versus an institutional VC fund, the VC fund is investing other people, their limited partners, money, and they have to make some minimum threshold of returns to return to those LPs so that they can go raise the next fund and continue investing. And I think a lot of that has led to needing companies to exit at, $1 billion or more, be these huge unicorns, in order for the venture capitalists that invested early to be able to return that fund and provide the returns that they promised to their limited partners or investors. Meanwhile, it seems like angels don't really have those strings attached, really. So I guess, can we talk a little bit more about, what differentiates raising angel investment from VC investment, and how that might actually be better for the types of businesses that you were discussing?
Yeah, it's the fund dynamics, right? And there's all of these drivers behind the scenes in VC deals that are all due to the fact that the VC is investing out of a fund that lumps a certain number of companies together. There's got 2 main, I think, incentives that are driving this mega fund trend, right? And it's, one is you've had these initial funds, these top funds that have been invested in by Yale's endowment, Harvard endowment. They've performed super well, right? And they've created Facebook and Uber, and they've delivered some of the best institutional investment returns to these large billion-dollar pools of capital that have ever been returned. And so now you have all of these, the largest institutions in the world just in the last 20, 30 years have started relying on venture capital to drive the highest rate of return in their whole portfolio out of all the asset classes, right? And so that's VC's spot in the world. And these are big buckets of money, so it's hard to make any, it's hard. You got to make a lot of money to really make a difference, let alone make the biggest difference. They got to put a lot of money to work through this stuff, right? And then the other side of it, VCs get paid a percentage of their AUM, right? And so the bigger your fund, the more money the VCs take home. And so that's the other incentive on the other side, to keep raising more funds. And obviously, the more money you have as a company, it's a competitive advantage and all that. So you've got this trend, and I don't think it's slowing down. If you look at the data since the pandemic, I think this is also one of those trends that's only accelerating after the pandemic. And you had in the 2 quarters after COVID, you actually had more capital raised year over year than you did in 2019, but you had half the number of new funds raised. And so much larger funds. So the reason that matters as an entrepreneur to understand these dynamics is because once you take a VC, you're part of that portfolio. And for that to even to get the money, you have to do this. If you have to build confidence and conviction in the VC that your company can not only be a good company, it's to be a good investment, not just a positive investment, but an investment that can cover the losses of their other investments, the 8 out of 10 companies that don't really deliver any returns, and then also drive the returns for their investors, right? Which is usually kind of 3x the fund size, right? And so if you've got $100 million fund, you need to have, and you assume you're going to have, say, average ownership upon exit of 1/3 of the company, so 33%. You got a $100 million fund, you need to have $900 million worth of exits in your portfolio, cash exits, to hit your return target, right? And so if it's only 2 companies, maybe 1 company that are going to hit that return target, you're talking, you've got to sell for $500 million, right? And these are small VC numbers, right? This is as small as it gets, right? If you get $1 billion fund, you need to return $3 billion to investors, and you need to have $9 billion in exit value, right? And so that's what you're signing up for if you take money from a VC. So yeah, I think that's what you want to consider. And these other, and then the other thing is, I think you can do it what I'm talking about, kind of set the company up for an exit at $5 or $10 million, raise a couple rounds there, and then when you get to $5 or $10 million, you can still decide to go down the VC route. And you can still go do that. But, if you go right out the gate and raise money at $10 million pre, and you don't have anything, and you can't raise more money, your investors is just not going to line up if you go to sell it, right? But if you raise money at a $1 million pre or $3 million pre, and you can still get a couple $1 million in revenue by the end of it, there's still a chance you make it. So.
Yeah, no. I totally understand everything you're saying. One way I like to think about it is, a $50 million exit for people that invested early, like angel investors, and probably for the founding team as well. $50 million exit is really good, and everybody ends up walking away doing really well. But a $50 million exit from the perspective of a $200 or $300 million fund is not very good, because that returns $15 million and doesn't really move the needle towards where they need to get. So I think you've hit on something really interesting with kind of the different ways that the dynamics of angel investors don't really tie your hands to kind of running the rat race, if you will, the same way raising from a big institutional VC fund would be.
Right.
So I've got a couple more personal questions that I want to ask you about, but also audience, we're going to open this up for audience questions after this. So we collected a few at the front, but if you have any questions for Nick that you'd like his perspective on, go ahead and throw those in the chat, and we'll get to those in a second as well. So my next question is, of those 3 different options, what are the ones that you're most excited about, and where have you seen the most movement or change in the last couple of years?
I think the actual most movement is in crowdfunding right now. And I think that is been working very well on the non-equity side. And I think it's just Kickstarter has changed the game for so many projects and initiatives. And the SEC has been working on it. And, the Jobs Act was passed. I think it was passed in 2012 and then enacted in 2016, but don't quote me on that. But it's been around for 5 years or something. And then this new update is a big deal that should help. And and I think really it's the platforms get a lot of credit. Heather from Republic was commenting. I've been super impressed. I think there's just as much, if not more, money getting invested through these crowdfunding platforms, the top platforms, as a VC fund. And so and soon it's going to be way more. And these crowdfunding platforms are going to be putting $1 billion to work through there, where, I guess that is about as much as the biggest funds. So yeah, I think that's big. And I think it really is going to allow us to tap into the Shark Tank nerve, and this, the whole world is really falling in love with startups. And you think that everyone that watched Shark Tank wouldn't love to throw a couple $100 at a startup here or there. And, and participate. And back to my point is like that should be able to happen, and it's like, so hard to make money without money in this country, and like and like you always have to pay these fees and licenses and all this stuff, and like, yeah, I think the more we can allow everyday people to invest in startups and learn to do it instead of kind of pretending like they're not smart enough to do it, the better and the more prosperity we're going to be able to get out of this.
Yeah, definitely. And I do agree with you. Like some of these platforms like Republic and Seed Invest and all those different platforms, they're positioning these companies in a way where any layperson can kind of go check out a certain company's Republic funding site and get a lot of due diligence. They can get a pitch deck. They can ask questions of the founders, and they can really do it in an intelligent way. So I really like what you said about like kind of itching that Shark Tank nerve that we collectively as Americans have. Definitely think there's something there. So last question here before we get into some of the ones from the audience. But what are some of the mistakes that you notice in companies that are going out trying to raise VC funding?
The most common thing is people just go out and start talking to investors. I think most entrepreneurs are hustlers and they feel like they can just go start talking to people and make a deal happen. And that happens. But the thing is maybe a 50-50 chance. If you've got a good venture, you go do that, you get funding. But then there's also a 50-50 chance that you set the deal up in some weird way, or just there's probably a 95% chance that the deal is not the optimal deal you could have gotten for the company. And so, as much as I think you should never pass on an opportunity to build relationships with investors or communicate the vision of your company to investors or solicit feedback on fundraising strategy concepts and ideas. I think, you don't want to go out and say, hey, I'm starting my fundraising and just go start having conversations. I think you want to build a campaign, and the first half of that campaign is preparation work, which allows you to narrow in on a intersection where you have a particular class of investors that will fit a particular fundraising strategy for your company, and then you hyper target the people that are like a fit for that strategy and engage them all in parallel. So I think that's the biggest thing, and fundraising is really something you got to switch gears for and like sit back and do some soul searching and make some hard decisions. And it's not something like a bootstrap startup where you're just kind of trying to crank stuff out because you only get one chance at your first round. And once you take that money, you've signed up for your, you've called your shot and signed up for your destiny.
Yeah, no, definitely. I like what you said about half of its preparation. And for companies that aren't able to do that preparation, one thing that you can actually learn through just having conversations with investors before you're actively fundraising, trying to figure out what they're looking for and kind of match it to what you're looking for is, maybe VC isn't the right route for you. Maybe you should go the revenue-based financing route, or maybe you should focus on angels or do an equity crowdfunding raise instead. So definitely totally agree with you there.
And no matter what you end up doing, the practice of thinking through it and doing the math will make you 10 times more confident when you speak to investors, which I think is actually the biggest factor. Is, investors can tell if you're, eye of the tiger, you're going to give me that money and like this is the best thing for you, versus like I'm kind of trying to go through the motions here and see if I get a check. So
Yeah,
very obvious.
Yeah, confidence is key, as with everything. Well, awesome. That kind of finalizes some of the questions that I have for you. Now we're going to jump into audience questions. So audience, you can type your questions directly in the YouTube chat. Looks like we've got our first one already. This one comes from Brenna. Brenna asks, where in Austin would you recommend to go to connect with entrepreneurs during the pandemic? Love the virtual world, but looking to make some in-person connections, specifically in the music/tech world.
It's a good question. My view changes on this stuff every day, it feels like. But right now, I think my thought is we're not going back to initial meetings in person. I think like if there's anything that like I've found value in is not running around town trying to introduce myself in person to everybody. So I think what I'd recommend doing is going to stuff like this, looking in the chat, finding people online, having a quick chat, 20 minutes virtually, and then, having a nice socially distant, engagement, I think is totally fine. Or even, get a couple people together. I can't name a place like right now to go to. You can't even go, like this is the first time I've been downtown in a while. I live out by Lake Travis, and can't the coffee shops, you can't sit down and meet in or anything. So yeah, I think that would be my advice. It's just so much more efficient to kind of qualify your connections and your relationships online, and then go meet them in person, to the point where it's like, you could qualify people online, and it's so much, and you save so much time and resources that you can just start flying to go meet people in person, like if you're comfortable flying or driving or whatever. But like, my point is, you can expand your horizons behind your city, and like that's what I'm thinking about doing. Is I'm meeting all these entrepreneurs all over the country, and I'm really making a point to go beyond Austin. And probably like next spring, I'm going to start every month flying to one of these cities and connecting with people in person too. So my hunch is we're not going back to first introduction meetings over coffee. Maybe sometimes, and then I also just think that the whole startup community is going to get reorganized, and like, startup community is unique, where it's all geographically focused. Capital Factory is a great example, but everywhere you go, it's very focused on the city. And I don't know if that's really going to come back either. And so I think it's really, and the perfect world is, Silicon Valley becomes the whole country, and we're just all intertwined, and it's 20 times bigger than it is today.
Yeah, yeah, and I think the first steps are there. The only thing I'd add is, like Nick said, there's tons of virtual events, places to connect with people in the chat. Capital Factory obviously does a lot of them and does them the best, but lots of other platforms do them as well. And one platform I've been using just to connect with interesting people around the country is Lunch Club, lunchclub.ai. You put in your preferences, and it automatically matches you with other people that match that preference. And it's a really cool way to kind of get some variety and meet new people that have similar interests. So moving on, looks like we've got another question from Brenna. And this actually ties in really well to one of our previous questions. So Brenna asks, what tools would you recommend to find angel investors? And the question we got ahead of time is, what is some of the advice to early stage startups that you would have for early stage startups that might not have a network of angel investors to provide that initial 20K-ish worth of funding to get a tech company off the ground?
Mm-hmm. Yeah, it's a great question. LinkedIn, number one spot. I want to make sure to say LinkedIn is for hustlers, because it's literally just everybody that's trying to make deals, and everyone who's not trying to make deals is just making fun of everyone on LinkedIn, saying I am. But I honestly feel like the people that are on LinkedIn right now are going to be way ahead in the world in the future. And the cool thing about another cool thing about LinkedIn is the distribution is way more, because it's not an ad-based platform, and they don't want you to pay to actually have people see your content. So as long as if you get the pro version, your posts go a lot farther. My post for this event got 5,000 views and 60 likes, and it's just kind of an average post, which so yeah, I think that's super helpful. And the most important part in connecting with angel investors is really qualifying the people and getting as targeted as you can, and avoiding as much wasted time as possible with investors who are either not investing or aren't a fit, or aren't a cultural fit, or whatever reason. So it's qualifying them. I don't know if I am quite to the point where I really recommend Crunchbase or any of the databases for angel investors, although you can find them on there, and Crunchbase is not that expensive, so it might be worth it. But kind of reverse engineering from similar deals, and if you can figure out just like similar companies that have been funded in your space, and then find who invested in those companies, and then go reach out to those people on LinkedIn. And when you reach out, like, there's a lot you can learn on LinkedIn and make it work. Like the only people that call out for being spammy on LinkedIn are the people that you can tell, and it's like, I think the key thing, get your profile credibility, make it 100% your business. Like, I get entrepreneurs who reach out to me like about their business and say they're fundraising, and then there's like nothing on their LinkedIn about it. Like, it's not going to work. And so yeah, make sure your profile says credibility. If you got pictures of the famous person, put that in the background. That's a great trick. Got one with Mark Cuban and Bob McCaff on mine. And then Other thing, being very targeted with your outreach, and really using your human intellect to understand, okay, what am I going to say to this person in 2 sentences that's going to cause them to act, right? And like, what's the special piece about my venture, especially as it relates to this person I'm reaching out to, that's going to like get them to have a reaction and respond to you. And if you can really tap into a nerve there and find the right people, you'll get responses. And really that tapping in a nerve piece and qualifying them is like anything in life. I'm so convinced that if you've got the right pitch and like, it doesn't matter your network, like you can get in the door if you got the right things to say. So yeah, that would be my advice for finding angel investors.
Awesome. Great advice. And I would just add a piece of advice that you gave me that I now give to Capital Factory companies is, if you're building a product that helps large insurance companies, look at executives of large insurance companies that would understand the value proposition and understand how it could integrate with their workflows, because they've probably got some money to invest, and they probably also don't get a ton of startup deals, so it would be an exciting opportunity for them.
Yeah, those are the best. Usually, when I see an investor, usually when I see a startup who's doing really well with angel investors, it's because they've tapped into their market and they're getting a lot of industry professionals. And yeah, I think they can't go understated the deal flow element. If you can find executives who are able to invest but aren't actively doing it, it becomes a lot less competitive for you versus going down to the local angel network where they're getting, all the deals in the whole state are getting funneled toward that. Not that you shouldn't do that, but it's much less competitive if you skate to your industry, especially if you start making waves and disrupting the industry. Then I think it can really work well.
Definitely. So our next question comes to us from Heike Jost. Apologies if I butchered that name, but Heike asks, how do I find out pricing for a country-restricted sales license if I wanted to go that route for funding?
I don't know what a country-restricted sales license is, so I'm not going to be helpful on this one.
Okay, that's fair. I'm not super familiar with that either. But Heike, shoot us a message or an email, and we'll do our best to answer that question. So the next question comes to us from Shafiq. Good to see you here, Shafiq. Shafiq asks, how do you see early stage debt financing becoming more common? For example, a 12-month term at 20% interest versus revenue-based financing that sometimes pays out at a significantly higher rate of 50 to 200%.
Mm-hmm, mm-hmm. Well, I would say revenue-based financing is debt, and I think if you can get a traditional loan, take it. I think the gap that I'm trying to fill is really that spot where you can't get a traditional loan, and you're approaching investors who want to have a little piece of the upside and a little opportunity for growth, a little more risk than a loan. So yeah, that's where I see it. You can also do a loan like that's. I mean, it's not a bad option. And I've done that with some like personal ventures. If you can find usually you can't get a secured loan if you don't have a business because you don't have the financial history. So the SBA has good opportunities. I don't know how hard they are to get exactly, but I know the loans are good through that. And then yeah, if you find a wealthy individual who just wants to help and they really just want to help, they're not looking at making money or anything fancy, then they might be able to do a debt loan too with just a kind of traditional unsecured personal loan type thing. So I think the most important part is doing the math and lining it up. Like I think and whether it's 200K on revenue based financing or 500K on equity, it's like, okay, what's the real end game here? Like, what does a company need to get to in order to have the minimal viable exit? I don't know, maybe I'll start talking about that's a good, like, instead of an MVP, it's like the MVA, like what's your minimum viable exit, which is usually around $5 or $10 million. And like make sure you can get that back and like you're able to communicate that compelling return. And also it might get bigger. right? But just being able to have that initial spot, and whether it's a loan or a RBF deal, like it, two things matter. It's like, one, what is the investor going to go for and understand, and then two is like, what's the better cost of capital. And in my opinion, I'm not thinking too much about cost of capital if you're early stage startup just trying to get off the ground. I think the goal is to get off the ground and pay the investors back, and then as you become more established financially, it's more of a numbers game of really, okay, is it 7% interest or 8% interest or things like that.
Yeah, I love what you said about minimum viable exit. You should write a Medium post about that for sure.
I might.
So our next question comes to us from Natalie Renz, and Natalie asks, do you have any advice for connecting with family offices?
That it's a tough one. That they're not easy to connect with. It takes a lot of time, to build relationships, to build trust. If you've seen one family office, you've seen one family office. They're all different, and so I think every one you're approaching, you really want to understand what's the origins of the wealth, what are the family dynamics, right? Is the pop alive, or is the younger generation in control now? It's for startups. I think it's a much better situation if the younger generations, and it's not cheap, but if you're serious about it, the best tool I've found is fintrx.com, and it is an awesome database of family offices, including their contact information. Tell them, if you reach out to them, tell them I sent you the and let me know too. I want to be a referrer to Fintrix, so if you do it, I'm gonna try to get you a deal on the back end.
Yeah, very, very powerful platform there for sure.
I mean, it's, you got to have something to talk about, right? Because it's easy. You can go email all of them, and if you don't have that right value prop that gets them to act, you're not going to get a response. But using Capital Factory's brand and our mission for Texas, like I was able to get in the door with a lot, like way easier than I thought, and just kind of reaffirms that if you got something good to talk about that plays into their interests, then they'll give you a listen.
Yeah.
One more thing, sorry, Jay, is like with family offices, there's this it's more of a wealth preservation mindset, right? And so you gotta, and most of the chief investment officers, they're trying to make sure the wealth doesn't go away, right? They're not necessarily like that worried about going from $1 billion to $2 billion, which makes it much harder for startups. And I almost recommend startups like approach them like they're an artist, right? And you got so much money going into philanthropy and art, and like it's usually the family, I think, that will like buy into that stuff. So yeah, I would target the family, and I would really hit on the emotional chords, not really focus on the financial side as much, unless they're like, hey, we're looking to do early stage startup investments, and then it's probably more of a financial conversation. But most of them aren't really proactively looking to do that.
Yeah, it seems like a lot of this advice is tying back into what you said earlier, which is just have a really compelling 2 or 3 sentences that'll get people hooked and get them interested in talking to you.
And like personalizing that, right? And it's your core message. It's Starbucks, it's like their 80-20 rule. When they go into a new city, it's like 80% of their brand is like their traditional Starbucks stuff, and 20% of it will be local to that specific market. And so I think that's like the personalization piece is what's going to really cause people to perk up, right? And it's like one I love this. I haven't tried this, but I heard someone actually who say one of these family offices has a big holding in a company, right? A public company, right? You can go look into that public company's financials to figure out like what are the things they're worried about, right? Or like what are the triggers in the language? And there's like there's specific words that you can find for people that run their businesses that like make them perk up, right? And whatever it is, and it's usually like a buzzword, but if you find the right one for the right person, like that's what causes that action. It's called a trigger.
Awesome. So looks like we've still got a few more questions. So want to get through all those before we have to end here today. This next one comes to us from Renee Graham. Great to see you here, Renee. Renee asks, hi guys, I've had potential investors ask about what the next round would look like. Can you give some insight as to why they're asking this and how to think about it from the founder perspective?
Yeah, it's a great question. And just
Awesome.
wrapping up on the last point I see from Paul, it is Fintrix, fintrx.com. You spelled that right. But Renee, it is good to see you here, and hope you're well. I think it's investors care. Investors care about their investment being a good investment, right? And a big factor in that is the total capital requirement before you exit, right? Or the investors exit. It doesn't necessarily have to be your exit, but like the investors want to get their money back. They're going to ask, like, one, they want to know how much money you're raising in the future, because they want to understand if what you're saying you're going to accomplish is feasible, giving the capital you're planning on raising. The other side of that is, they want to make sure you're not going to raise so much capital that they're going to be diluted so much that their ownership at the ultimate exit isn't that meaningful. And you've got an environment now where you've got these mega funds that come in and they're putting $100 million in these companies before the liquidation event. It's get crammed down pretty small on some of the deals. So that's the other piece of it. And so there's a few reasons. In the shorter term, they want to probably just figure out if you're raising enough today to hit the milestones you need to raise the next round, right? And understanding that. So yeah, it's fundraising strategy questions and kind of connecting the dots to that ultimate outcome.
Yeah, it's painting the picture for that eventual exit for the investor, so they can kind of see it in their mind's eye.
Yep.
Next question comes to us from Cass Milner. Cass, great to see you here as well. Cass asks, device-based versus SaaS-style startups. Which is better? Which is a better funding source for each, crowdfunding or device-based?
So which is better funding source? Yeah, it's good question. I feel like most of the companies I see now are device-based SaaS startups, and it's always like a little device and then some SaaS. It depends on if it's like a consumer device, like a gadget, or a industrial device that goes on a HVAC system or something. I'd say revenue-based financing is good for cash flow companies, right? And so I think generally SaaS is a good business model for RBF because you got strong, predictable revenue, high profit margins, so you can deliver on that. Crowdfunding, it's SaaS is a little tougher just because it's not as common for your everyday investor, and so the companies that do well on crowdfunding have strong, loyal audiences, right? And usually, developed through social media or customer base. They probably might not have a tangible product or gadget, but a lot of times that's what you'll see if you've got a cool video for your at home live streams or stuff like that. Like that could do really well on crowdfunding. Especially if there's no cash flow, then the revenue-based financing doesn't work as well. So yeah, that's what I'd say. Kind of more companies with strong following, people want to get involved, cool consumer aspect to it that's engaging to consumer essentially would be good for crowdfunding. Then companies with just strong cash flow and revenues, more of the RBF side.
Yeah. So this next question comes to us from Soundboard Records. Great name, by the way. Soundboard asked, how feasible is it to get VC investors if your startup doesn't have as many competitors as the next startup, whether you're entering a fairly new market or attempting to shift an already established market?
Mm-hmm. Well, I think if you have not a lot of obvious competitors, it can be easier to get a VC funding, because a lot of times those are the big opportunities. And I think when I think of companies like Airbnb, are there these companies that like basically created a new category, right? Same thing with Uber, right? Or it's not quite a whole new category, but it was in the sense that the market size for Airbnb was way larger than hotels. And if you look into the financing of Airbnb, everyone was like, oh, hotels, it's not that big. Like there's not, but really what they realize it's much larger than that in some ways. I don't know exactly, but you could go watch their IPO video still this week, I think. And they'll tell you. So yeah, I think in that sense, VCs like space without a lot of competitors. They like one winner take all market. That's the big one. Is like, hey, there's going to be 2 or 3 winners in this space, and it's going to be really hard for a bunch of competitors to come in. So that's probably the most important thing for them. So the second part is entering really market shift. Yeah. So yeah, I think it's VCs like to do that. I think the important part is to really understand what your market's going to be, because you don't have the comparable companies in that situation, and being able to pitch it accurately to investors as a big opportunity. VCs is a big opportunity. So they might say, oh, like, yeah, hotels, like, you're not really going to be able to do much there. But if it's actually like, oh, well, because we've done it differently in people's houses and we can go all over and it's unique, whatever, that can be a good thing for VCs.
Awesome. And then we have one more question here, and then we'll wrap things up for today. This question comes to us from Chasm. Again, great to see you guys here. Chasm asks, what are the qualities of the company for the most successful seed rounds you've seen? How do you get investors competing for you? And what do you do if you're oversubscribed?
Most successful seed rounds. Yeah, the most successful seed rounds you'll see are from experienced entrepreneurs, hands down. Icon 3D makes sense. It's, Evan Loomis got involved with some smart people, and they raised $9 million seed round. And once you've proven you can walk the path and get money back, you can do really big ones. That's probably not super helpful to everyone watching this. I think like what the number one pattern I picked up on like kind of first time entrepreneurs who get funded and ultimately figure it out. Blake Garrett from Aceable is a great example. So are the guys from Sparefoot, but they're super coachable and they're very iterative in a smart, like diligent way, right? And I think both Sparefoot and Aceable are companies that entered Capital Factory in the early days and didn't look any different than any other company. They're now both portfolio leaders in massive companies from our perspective. But they, you couldn't really say they're special. I wouldn't say they're bad. Definitely awesome people, hard workers, but everyone on this phone call probably is too. But I think, yeah, they were here day in, day out. They listened to mentors, they adapted the business model, and ultimately, like, they struck a chord, right? And they figured it out long enough until they hit the nail on the head, and then it goes off, right? And so I think that's really what I would think of in the seed phase. There's not, there's actually a handful of rounds within the seed phase. And the goal of that phase is to continue being able to learn as much as you can until you hit product market fit and can scale, right? And then there's a second part. How do you get investors competing for you, and what do you do if you're oversubscribed? Great question. It does happen. I think it's actually easier maybe than people think. It comes back to that campaign centric approach of actually going through the process up front of thinking through your fundraising strategy, putting together your materials. So when you engage investors, you don't hit friction points and have to, let me go back and make that slide for you. Let me go back and that doesn't increase the odds of you getting funded. And then you don't, once you have the strategy and the materials, you don't go right out and start raising money. You go and have an informal fundraising phase, right? And where you go out, you talk to the investors you've put on your prospect list, but it's very informal. You say, hey, we're not raising money right now, but we're probably going to in the future. We think you might be a great fit, and we'd love to get to know you and get some feedback on our potential fundraising strategy. We're just informal for now, and have these conversations. Pitch your company. You kind of give them an idea of what you're thinking about with your fundraising strategy, and then hopefully their eyes light up and they buy into it. And you're like, yeah, this is good, man. You should keep doing that. They'll give you a couple ideas, but you can kind of tell them. And if you ask the right questions about their investment thesis, you can qualify them as a fit or not for your fundraising strategy, right? And so it's like, does their thesis fit your strategy? Do their eyes light up? And do you have that relationship? And you go through that informal phase and you do that, and you get 15 people that have kind of checked both those boxes, right? And then you've got a nice roster of investors that you can engage in parallel during the formal fundraising process. And engaging them in parallel in a time-boxed campaign fashion is going to create a competitive environment for you when you're talking to those investors. And so when you start that formal fundraising process, you say, hey, it was great to talk to you a month ago. Like I said, when we hit XYZ milestones, we were planning to raise XYZ funding. We've hit those milestones and are starting conversations with about 15 investors we think could be a fit, including you. Is there a time we can get on your calendar next week? And you go engage all of them in parallel over the course of a couple of weeks, and you're able to, kind of subtly reference these conversations. And then, investors start talking about each other behind their back. And then eventually someone gives you a term sheet, right? And you say, I'm expecting term sheets by this date. And then you've got a lead, and you can go back to everyone else and say, hey, all right, well, we've got a lead. This is how much they're putting in. Here's the allocation. Please let us know if you would like to participate. Ideally, you only need like 4 or 5 of the 15 to convert to close the whole round. And so then you go through and then, maybe you get 7 people out of the 5, or 7 people trying to get into the 5 spaces. And then you get to pick favorites, right? And you kind of say, okay, who do I really want in the round? Who do I, maybe can I pass on, or it's just not really worth it? And then if you kind of say, okay, here are the people I really want in the round, and they're not, they're not, there's still not enough room. You go to them and you just, for the people that you think it doesn't matter as much to how much they put in, you ask them to put in less. You say, hey, would you mind, just put it into this or that? You can oversubscribe too. Like, that's totally, happens a lot too. But I think you're going to create more of a scarcity factor if you actually ask people to decrease your commitment, and then, go raise the next round later.
Awesome. Well, great advice, Nick. It's great being able to talk with you like this and kind of hear your perspectives on it outside of Capital Factory now. That wraps us up with all the questions today. But before we go, I want to kind of turn the mic over to you. Can you kind of give us a summary of everything we've discussed today, and also talk about how to get in touch with you if there's any companies that would like to maybe work with you or get some more feedback on other questions that they might have?
Yeah. Well, I think we're entering a whole new era of startups. Coming out of this pandemic, I think it's the mega fund trend is picking up. I think VCs becoming its own thing. And really it's coming to the point where it's any companies less than $1 million in revenue just really aren't even a fit unless you're a seed fund. Alternative investing is coming on hot. I think revenue-based financing, positioning your startup as a cash flow investment is very attractive to traditional investors here in Texas, or really anywhere they're doing real estate, oil and gas type stuff. Crowdfunding, the platforms are doing great. There's investor audiences who are writing checks, and the regulations have came a long way. So very, very interesting there. And yeah, we'll see how it all shakes out. I think, there's it's a cash crunch out there, and there's been a bunch of government stimulus, and it hasn't quite naturalized. And we'll see in the next year what happens with the funding situation. But more or less, I think you're going to want to get scrappy and creative and have options. Versus going right out and just talking to investors and trying to work a deal. And one of those options should probably be like, what happens if we don't raise any money? And sometimes that just isn't an option. But if it is, I would definitely have that plan in my back pocket. Don't believe everything they tell you on TV, and reach out to me on LinkedIn.
Yeah. So I guess, now you're a private fundraising coach. How would you prefer companies to get in touch with you? Is it LinkedIn? Do you want them to shoot you an email or?
Yeah, no, I think LinkedIn is the easiest. I'm on it every day. You can read a little bit more about my background, and reach out to me and we'll set up a call. I'll respond immediately.
Awesome. Well, Nick, thanks so much for being here today. It was great talking with you and hearing some more about some of those fundraising alternatives. I know I learned a lot, and hopefully the audience did as well. So, thanks so much for being here.
Thanks, Jake. Are you going to conclude the event by playing that piano behind you?
Yeah, no, this is my very, very nice Austin mansion. So I'm gonna head out and get some Elton John in real quick.
Okay, but you're not for us, just for yourself.
Not for you guys. Yeah, no, I have stage fright.
All right, let's head home then. Thanks, everybody.
All right, thanks, guys.